Hello everyone, my name is Evelyn Zulsinaga from class AKT 23A Accounting Study Program. In this video, I will explain about PPh 25. PPh or Income Tax Article 25 is actually a type of tax imposed by the government of the Republic of Indonesia. However, in certain contexts, the term article is often used incorrectly as an abbreviation to refer to tax-related regulation. Technically, the article in the tax law discusses various things including the subject, object, amount of tax, and how to calculate it. However, if we talk about PPh, which is directly related to income from abroad, then we make a slight typo, or in common language, it is called PPh Article 25, even though this rule is actually in the tax law enforced at the time. This rule is very important because it discusses the taxes that apply to taxpayers who receive income from abroad. The subject of PPh Article 25 is taxpayers who receive income from abroad. Meanwhile, the tax objects include various sources of income such as dividends, bank interest, royalties, and other income received from permanent business abroad. For example, if you work for an international company and receive a monthly salary, then the salary will be counted as net income, which must be taken into account in calculating your total income. To calculate the amount of tax must be paid, taxpayers must add up their total gross income or income before deducting expenses, including income from abroad. After that, the income is subtracted from the cost to get income net. After that, the amount of tax that must be paid is calculated based on the applicable tax rates. This tax rate usually ranges from 5% to 35%, depending on the level of gross profits earned. Apart from that, there is also a maximum tax credit limit that can be credited to tax award in Indonesia. This limit is usually set based on the proportion of foreign income to total gross income. Example, total gross income 100,000, operational cost 20,000, then your net income is 80,000. If the applicable rate is 15%, then the amount of tax that must be paid 12,000. However, if you have other income abroad of 30,000 and have already paid off 5,000 there, then you only need to pay an education tax 6,000 in Indonesia, because the maximum tax credit then can be used is 10% of total gross income. Suppose you have a stock in investment is an international company and receive dividends of 1,500 every month. The dividend is equivalent to approximately 18 million per month if you use to USD or their exchange rate in effect at that time. Based on the just example above, do you still need to pay again? The answer is yes, because even though you have paid taxes in the country where the shares are owned, it is not necessarily pledged enough, so you still need to pay again in your country of origin, namely Indonesia. For this reason, It is very important to always monitoring development in national and international fiscal regulation so as not to be subject to double taxation, which is detrimental to oneself. Topic of PPh article, this is really important for anyone who wants to improve their professional career in the field of international economics later because there is not a single modern business organization that has never operated across traditional geographic boundaries.